What do you see as current viable alternatives to securitisation?
Well, as we discussed earlier, securitisation remains our primary source of funding once we refinance off our warehouse lines. So unlike banks, we're unable to sort of accept deposits. We're not licensed banks. So clearly it remains our primary source of funding. One other area of the market that we have looked at and participated in before is what's called whole loan sales, where we look to sell portfolios of loans on a private placement basis. That market's not particularly liquid in Australia. It's a liquid market more in the UK, but it's certainly an area that we're looking to sort of foster more activity going forward. But in reality, securitisation will remain our primary source of funding.
Are there any parties that you can identify that has weathered the impacts of the funds increase better than others?
Certainly, weathering the crisis, I think right now it would be much easier being a bank and have access to a more diversified funding base. So, banks having a large access to a deposit base or wholesale funding under their credit rating clearly diversifies their source of funding for mortgages. For the non-banks, it's clearly much tougher when there's this dislocation in debt markets. My personal view is that the non-conforming lending space, because there's more margin in our underlying portfolios due to the fact that we take on a little bit more credit risk, I think our models are more robust in terms of having that excess margin. There's less pressure on our business model as there might be on, say, non-bank wholesale prime lenders where the margins in their loan books are much thinner.
With an increase in the cost of funds comes an increase in competition. Has this impacted on the way you position your distribution channels?
Increased competition, I think to some extent this crisis has probably caused some greater barriers to entry, certainly into the non-conforming market. It will be harder for new players to come into this market, particularly securing warehousing funding to start with. So if anything, I think that actually prevents or inhibits the level of competition to us as a lender. In terms of distribution, Pepper, like most of the non-conforming lenders, distributes its product mainly through third-party brokers. I don't believe that's going to change as a result of this crisis. In fact, brokers have been incredibly supportive of our business, and I think the whole sector in understanding very early on in the process that there was going to be a dislocation in our funding processes. But I think they've also understood that the various changes we've made to product and our funding costs increasing during that period, they've understood, and I think they've really helped us continue business as usual during this period.
How do you factor in risk when weighing up funding options?
Well, risk is obviously critical to our business. Our whole lending ethos is based on a pricing for risk model in terms of the credit quality of the underlying borrowers. Unlike prime lenders, we don't rely on lenders' mortgage insurance to provide credit enhancement to our mortgage-backed deals. So, risk is critical. We tier our deals right down from AAA rated paper right down to unrated equity. So it's a fundamental part of the way we look at, funding in this market. It still doesn't change the fact that we rely on securitisation as our primary source of funding exit, so that will continue.
Will this recent increase in the cost of funds force buyers of RMBS to adapt to new trading conditions?
I think certainly from an investor perspective, this market creates much more opportunity for those investors that truly understand the RMBS space, and by that I mean, certainly in our case, non-conforming paper. It's offering very wide margins historically, so it's more attractive in terms of the margins they can earn. I think margins over time will probably settle back closer to maybe 2002 pricing levels. Right now there's a premium, a liquidity premium being paid by investors. I think that may come back to more rational levels perhaps after the first half of 2008, but certainly I think it creates a lot of opportunities for investors. So there's some good buying to be had in this market, and certainly I don't think margins will go back to where they were, for example, when we priced our PRS 6 deal in March of this year.
Looking ahead, what alternate forms of funding would Pepper Home Loans consider?
I guess given what we talked about earlier in terms of securitisation being our primary source, we clearly don't have too many alternatives. We will look at whole loan trading, perhaps in this environment, if we can find appropriate funding partners. But the fact is securitisation will remain the primary source of funding. I certainly have a lot of faith that the mortgage markets will come back to a more rational level, perhaps after the first quarter of next year. I think we're going to see a period of very wide margins. As an issue, we don't necessarily like that, but we recognise there's a premium for liquidity right now, and that's going to continue. But I think having been in these markets for 7 years now, we have confidence that the markets will come back. It's a question of how long it will take before that pricing settles down, but we'll continue to look to issue in this market through the first half of next year and beyond.